Welcome to The Explainer. Today, we're jumping into a really cool study that's all about one thing, helping banks in Kazakhstan make way smarter, safer, and more profitable lending decisions. It's basically a data-driven playbook.
All right, here's what we're going to cover. First, we'll look at the big challenge facing Kazakhstan's credit market. Then, we'll hunt down the real risk factors in the data. We'll check out a much smarter tool for predicting that risk, figure out how to group borrowers, and finally, put it all together into a solid, risk-based strategy.
All right, first things first. Let's really wrap our heads around the size of Kazakhstan's retail lending market. We're talking about a huge opportunity, but also a pretty significant hidden problem.
Okay, get this. The market is absolutely massive. We're talking over 12 trillion tenge. Now that's a huge engine for economic growth, for sure, but, and this is a big but, it's also carrying some serious underlying risk that you just can't sweep under the rug.
And this is what that risk actually looks like. This chart shows us the rate of non-performing loans. Bad debt. The loans that aren't getting paid back. And as you can see, it's been consistently hanging out above that 5% international benchmark, which is really the line you don't want to cross. It's just stubbornly high. So that brings us to the big question, right? How do you keep this massive growth engine humming along without putting the entire country's financial stability at risk? And that is the core challenge this study is trying to solve. Okay, so let's get into the good stuff, the data. What does it actually tell us? What are the biggest red flags that predict someone is going to default on their loan?
Well, after crunching all the numbers, two things really jump out. The two factors with the strongest link to default are, number one, the borrower's debt-to-income ratio, we call that DTI, and number two, their history of overdue payments. It's pretty simple, actually. If someone's already swimming in debt and has a track record of paying late, yep, the risk goes through the roof.
And I mean, the impact of DTI is just, wow, it's staggering. The model shows that for every single unit increase in someone's debt-to-income ratio, their odds of defaulting jump by 6.3 times. That's not a small number. That is a massive red flag.
And here's a super important finding, one that's really specific to the market in Kazakhstan. It turns out that people with informal employment, without an official job contract, are 1.7 times more likely to default. Now, if you're a lender there, this isn't just some random stat. This is a critical piece of the risk puzzle you have to pay attention to.
Okay, so it's great that we know the risk factors, but that's only half the battle, right? The real question is, how can a bank get ahead of this? How can you accurately predict the risk before you give out the money?
And this slide just shows the difference so clearly. It's like night and day. On the left, you've got the old-school method, logistic regression, which gets an accuracy score of about 0.74. Not bad. But then look at the right. That's a machine learning model called XGBoost, and it hits 0.87. Now that 13-point jump might sound a little technical, but what it really means is you're way, way better at spotting risk. It means fewer bad loans get approved, period.
And you know what's so cool about this? This smarter, more powerful model is basically telling us the same story. The top things it looks at to predict risk are, you guessed it, DTI, past overdue payments, income level, and that really important local factor, their employment type. This just gives us so much more confidence that we're on the right track.
So now we have this amazing, accurate model. The big question is, how do you actually use it? How does it help a loan officer on a Tuesday afternoon? Well, the answer is to stop treating everyone the same. It's all about smart borrower segmentation. Basically, the model lets us sort every potential borrower into one of three buckets. First, you have your low-risk group, which is a big chunk, almost half the people. Then you have your medium-risk folks, and finally, you have a smaller but super important high-risk group that makes up about 17% of the applicants.
And just look at how wildly different these groups are. It's not even close. The high-risk group, their average debt-to-income is 54%, more than double the low-risk folks. And get this, a whopping 71% of them have informal jobs. We're not talking about small tweaks here. These groups are living in completely different financial worlds.
All right, this is where it all comes together. Let's get to the most practical part of all. How do you turn all this data and all these segments into a concrete strategy, a real playbook for lending?
And this table is pretty much that playbook laid out for you. It's so clear. Instead of a one-size-fits-all loan, everything is customized. If you're low risk, great. You get better interest rates, a bigger loan, a longer term.
If you're in that medium group, okay, we'll need a bit more, like income verification and maybe a guarantor. And if you're high risk, the terms get much tighter. A smaller loan, a shorter term, and we're definitely going to need some collateral. It just makes sense.
And this whole approach has a name. It's called risk-based pricing. And honestly, it's a win-win for everyone. Borrowers who are financially responsible get rewarded with the better terms they've earned. And at the same time, the bank protects itself from taking on too much bad debt. You end up with a system that's more profitable, sure, but also way fairer and more stable.
So that really leaves us with one final crucial question for any bank or lender in Kazakhstan. Are you still running your business based on averages, treating everyone more or less the same? Or are you using the data to see the real individual risk story of each person who walks through your door? Because as we've just seen, that one shift in perspective, well, it can make all the difference.